If you work in sustainability, you already know that your initiatives create real value. But can you prove it in the language of the finance team? There's often this huge gap between all the great ESG work being done and the cold, hard metrics that actually drive a company's stock price. Well, today, we're going to build a bridge across that gap. We are going to demystify a core financial concept, the weighted average cost of capital, or WACC, and I'm going to show you exactly how your work directly impacts what investors and the C-suite care about most, the company's total value. So let's dive in. Here's our game plan. First, we'll establish that crucial link between sustainability and financial value. Then, we're going to decode what WACC actually is, I promise, in simple terms. From there, we'll get to the real heart of it, how your ESG work directly pulls the levers on a company's cost of capital. And we'll wrap it all up by looking at a couple of real-world examples to see exactly how this plays out. All right, so let's start at the beginning, connecting what you do to the company's bottom line. Why should a sustainability pro even care about corporate finance? Well, because speaking this language, it isn't just a nice to have. Honestly, it's the key to proving your impact and unlocking the resources you need to make an even bigger difference. Let's just kick things off with a question. It seems simple on the surface, but it's got really deep financial roots. How does a company's water usage really affect its stock price? I mean, you might see a metric that says a company uses, say, 1.88 cubic meters of water per ton of steel. Okay, that's an efficiency stat for sure. But a financial analyst, they see a threat of risk. They're asking, was that water pulled from a region that's prone to drought? Is that number better or worse than their competitors? The answers to those questions, they don't just stay in a sustainability report. They signal real risks that directly impact financial valuation. What's really interesting is that every single thing a company does, from marketing campaigns to supply chain logistics, it all boils down to influencing the company's value through just 3 core levers. The first is profitability. Pretty simple, right? Turning revenue into profit. The second is growth. Are you capturing more of the market? And the third, and this is our big focus today, is risk. This lever asks one critical question. How much does it cost the company just to fund its own operations and growth? And right here, this is the key insight for today. Risk is the bridge that connects what you do every day to Wall Street. When you improve water efficiency in a stressed region, you're not just saving water, you are de-risking the company's operations. When you improve labor practices, you're mitigating potentially costly reputational and regulatory threats. The financial markets, they don't see these as abstract good deeds. They see them as measurable changes to the company's risk profile, and they price that risk directly into the company's value. Okay, so now that we've established risk as our bridge, let's look at the tool that finance pros use to actually measure it, the weighted average cost of capital, or WACC. I know, it sounds a little intimidating, but its job is actually pretty simple, to put a single number on a company's overall risk. This is how the market translates all those abstract risks into a concrete financial metric. Before we get to the whole weighted average thing, let's just focus on the cost of capital. The easiest way to think about this is like an interest rate for the entire company. It's the price the business pays for all the money it uses to run. Because let's face it, investors and lenders, they don't give you cash for free. They require a return on their investment. And the rule is simple. The higher the company's perceived risk, the higher the return they're going to demand. So where does all this capital come from? Well, generally, it's from 2 places. First, you've got equity. That's money from shareholders, the owners of the company. Second, you've got debt. That's money loaned from banks or bondholders. Now, most big companies use a mix of both. And just for our example here, we're going to look at a company that's funded 70% by equity and 30% by debt. This specific mix is called its capital structure. And this brings us right to the weighted average part of WACC. WACC is simply the blended, or average, cost of all a company's money, weighted by how much of each type it has. So in our 70-30 example, the cost of equity has a much bigger say in the final number than the cost of debt, just because there's more of it. You can think of it as the single hurdle rate the company has to clear to make every single person who gave them money, shareholders and lenders, happy. Let's look a little closer at these 2 costs. The cost of equity, that's the return shareholders demand. As owners, they take on the most risk. I mean, if things go belly up, they are the last in line to get paid. So naturally, they require a higher potential return. Now, the cost of debt, that's more straightforward. It's basically the interest rate on the company's loans. Here, the lender's biggest fear is default, that they're not going to get their money back. So if they perceive a higher risk of default, they're going to charge a higher interest rate. See the common thread? It all comes down to risk. Now, this table breaks it down. Don't worry, we're not going to do a ton of math here. You've got the two main costs, equity and debt, and how much weight they carry. But for us, the most important column is that last one, the key variables. For the cost of equity, the key lever is something called beta. Just think of this as a measure of how volatile or risky a company's stock is compared to the overall market. For the cost of debt, the lever is the credit spread. This is basically the extra interest a company pays because of its specific risk of defaulting. And these two variables, beta and credit spread, are exactly where your ESG work makes a real financial impact. Okay, this is where it all comes together. We get the pieces of WACC. Now let's draw a direct line from ESG performance to those key risk variables we just talked about. We're going to see exactly how your work managing environmental, social, and governance issues can literally change a company's beta and credit spread, and as a result, its total cost of capital. So let's start with the cost of equity and its risk lever, beta. To an investor, a high beta means high volatility, high unpredictability. But strong ESG performance, that's a powerful signal of stability. I mean, think about it. Good labor relations, that reduces the risk of costly strikes. Strong governance, that helps you avoid embarrassing scandals. Efficient water management, that creates a resilient supply chain. To an investor, this isn't just being a good corporate citizen. It's a sign of a less volatile, more predictable company. And that translates directly to a lower beta, which means a lower cost of equity and a lower WACC. Now let's talk about the cost of debt. A lender, a bank, they have one main concern: default risk. Are they going to get their money back? From their perspective, strong ESG is just smart risk management. For instance, a company with fantastic water management is way less likely to have its operations shut down by a drought. A company that's proactive on compliance is less likely to get hit with a massive cash-draining fine. Lenders see all this as a lower risk of default, and they reward it with better loan terms, like lower interest rates. This reduces the cost of debt, which again helps lower the company's total WACC. All right, enough with the theory, right? Let's make this really concrete. In this last section, we're going to put on our financial analyst hats. We'll see exactly how they take sustainability data, translate it into a risk assessment, and then actually adjust the numbers that determine a company's WACC. This quote here, it just sets the stage perfectly. Integrating ESG info isn't about feelings. It's about uncovering hidden risks. And the financial logic is rock solid. When an analyst perceives more risk, the discount rate, which for us is the WACC, goes up. And when the WACC goes up, the calculated value of the entire company goes down. The connection is that direct. So let's look at our first case, an iron and steel producer. An analyst knows this is a super water-intensive business. So they dig into a specific metric. What percentage of fresh water is being pulled from regions with high water stress? If that number is high, red flags immediately go up. It signals a major risk of supply disruptions, maybe even price shocks. So the analyst concludes this makes future earnings more volatile. How do they put a number on that? They manually adjust the company's beta upward. This directly increases the cost of equity, which raises the WACC, and as a result, lowers their valuation of the whole company. Okay, for our second example, let's switch gears to the auto industry. A massive risk right now is the supply chain for critical materials. We're talking about things like lithium, cobalt, all those rare earth minerals that are absolutely essential for EV batteries and modern cars. Any hiccup in that supply chain is a direct threat to a company's ability to even make their product. Now, picture an analyst digging through a company's sustainability report. They are looking for one thing: a clear, confident explanation of how the company is managing these critical material risks. If that disclosure is weak, or it's vague, or maybe it's missing entirely, it doesn't just get a bad grade. It creates genuine uncertainty about the company's future operations. And here is the financial consequence. That uncertainty, it doesn't just stay on the page. Investors see it, and they demand a higher risk premium to own that stock. In simple terms, they want to be paid more to take on the risk of a potential supply chain failure. This higher required return pushes up the company's cost of equity and once again inflates the overall WACC. But why does a seemingly small change in the WACC have such a massive impact? Well, the answer is a concept called terminal value. In a financial valuation, terminal value basically represents the worth of all of a company's future cash flows, from way out in the future, forever. And as you can see, this single number often accounts for more than half of a company's total calculated value. And the WACC is the rate used to discount that huge future value back to today. So even a tiny little tweak to the WACC, maybe driven by a single ESG risk, can have an absolutely enormous impact on the company's perceived worth. So let's boil this all down. Key takeaway number one: your work and sustainability is, in financial terms, risk management, period.
2, that risk is quantified by the market using the WACC. 3, the relationship is simple. A higher WACC means a lower company valuation. And maybe the most important takeaway of all is this. Managing ESG risks isn't something separate from finance. It is finance. You are actively working to lower your company's cost of capital and protect its long-term value.
So I'm going to leave you with a challenge. Go back to your organization and try to look at it through the eyes of an investor. What is that one sustainability risk, whether it's water, labor, or supply chains, that could be silently inflating your company's cost of capital? Identifying that risk isn't just a sustainability exercise anymore. It's the first step in speaking the powerful language of value creation. Thanks so much for joining us.